Operational consultants. What is operation restructuring? When the market becomes shaky, small firms are generally the first to experience the impacts. Therefore, developments in a small company's industry, such as a new rival or lower prices, may cause earnings or efficiency to fall. In such instances, a small company may attempt to restructure its operations to increase effectiveness or avoid bankruptcy. But first, if you're new here, consider subscribing to this channel to continue receiving great weekly videos on consulting. Don't forget to hit that notification bell so that you can get informed every time I publish a new video. Company reorganization is how a company in financial distress prepares and executes a restructuring plan to improve its economic position and allow the organization to continue operating. It usually entails adjustments to business activities and frequently involves working with some or all of the creditors to change payment conditions. By assisting in resolving unsatisfactory productivity problems, administrative reorganization strives to broaden a company's area of action and instill confidence in its customers, particularly lenders and its customers and contractors. Companies that, in other words, must achieve quick change while improving cash flow, and competitiveness. The operational restructuring team can assist people in implementing rapid change to increase cash flow, capital expenditures, and competitiveness. Informal and formal reconstruction are the two primary kinds of restructuring. These are two types of restructuring, official and informal. Because it is flexible and may be accomplished behind the scenes, unstructured reorganization is generally the least significant approach available to a corporation in an economic meltdown. A formalized restructuring is a legal procedure defined by the Corporations Act of 2001, such as legal protection, voluntary management, or unified data bankruptcy. Management of crisis. In a crisis, people are effective collaborators. People will swiftly and efficiently become acquainted with the company's functional architecture. People will quickly zero in on the major levers used to boost earnings or liquidity and put the steps they prescribe into action. Transactional knowledge. Selling or acquiring business lines may make sense in terms of restructuring operations. As seasoned merger and acquisitions advisors, we provide complete buy-side and purchase advice to our clients throughout the process, from market testing to transaction closing. Human capital. When reorganization measures influence employment structures, individuals communicate honestly with their workers, work out future opportunities for top performers, and reduce needless disagreements. If restructuring is inevitable, they will create redundancy plans and oversee all necessary processes in an exemplary, efficient, and competent manner. Examples of operational reorganization. Reorganizing. The process of reorganizing a business is known as restructuring. In contrast to a modest improvement, the term suggests a significant transformation. The following are some examples of common forms of restructuring. Acquisitions and consolidations. Bringing together management operation technology and two businesses. Legal. Modifying the legal framework of a firm, such as sole proprietorship. An organization, for instance, might develop its personal business institution. Economic. Any adjustment in such a profitable ratio, including recapitalization, allows it to continue operating despite money problems. Leadership. Rebuilding a failing institution's management, business, and products necessitates the appointment of new leadership. Repositioning. Repositioning is a transitional approach for a firm and its business units to a new business. Consider a company that sells software but is transitioning to a software payment system. Cost-cutting measures. Reduce operational and administrative costs in response to a decreased or projected decrease in revenue or margins. Offshoots. People are resurrecting a services business to turn it into a corporation while retaining certain management. A magnetization is often commonly utilized to gain a market premium for such a desirable part of a business. Reviving a failing business through operational restructuring. Purpose. When a company is experiencing negative profitability and an economic downturn, operational restructuring is frequently implemented as a rescue measure. Some companies recover and thrive, while others collapse and are removed from the stock market. This research aims to uncover variables that are strongly connected with the divestiture risk of reorganizing corporations. Design. The authors use a sample of enterprises that start to decline that underwent reorganization during the 2001 economic downturn. Regression analysis estimate is used to examine the divestiture risk of these firms following the relisting. Findings. According to the report, delisting risk grows when corporations engage in frequent restructurings, huge employee reductions, and large-scale asset downsizing. Firms with significant debt levels and an inability to minimize expenses and focus on core skills are also much more likely to be delisted. Consequences for practice. This model presents a framework for management to manage the design and implement a reorganization program to improve performance during an economic recession by assessing and synthesizing from empirical facts and business experience. Originality. The first study investigates the risk of discontinuing or surviving an underperforming corporation undertaking restructuring during an economic downturn. The restructuring of a company. The time required to accomplish a company restructuring can vary depending on whether the restructuring is reactive, when legal proceedings necessitate an industry to create clear and specific changes within a certain time frame, or assertive. Somehow, an intelligent business leader recognizes a shift in consumer preferences and desires to place his or her corporation to be a market professional in the area. Effective planning is essential regardless of the circumstances for a company's reorganization. It is vital to seek the advice of skilled professional throughout the planning phase to obtain a good restructure. The operational restructuring process is divided into 4 stages. Identifying which sections need to be reorganized. Identifying flaws and developing specific short-term and long-term plans to address these flaws via restructure. Taking prompt corrective action. Estimating and obtaining financing reform. The benefits and drawbacks of reorganization. When a company downsizes during a restructuring, its operational costs may fall. Employment expense, for example, will be reduced if the company dismisses part of its workers. Outsourced activities are also usually less expensive than labor. As a result, with reorganization, the cost to maintain operations inside the sales chain and the business, in particular, tends to fall. Communications and judgment frequently increase when a company reduces levels of government throughout the reorganization. Trying to simplify administration reorganizes a corporation's organizational structure, establishes communication channels, and eliminates impediments to production. Advantages and disadvantages of operation restructuring. The advantages of restructuring a business. There are numerous benefits to reorganizing a firm, just as innumerable reasons for a corporation to reorganize. Some financial rewards include rehabilitating a failing firm, boosting a company's worth and positioning it for sale and transfer to other generations. Other advantages include gaining a strategic advantage, such as assisting a business in setting itself for development, allowing for the introduction of new accounts, permitting expansion into recent geographic locations. However, 2 words summarize the full benefits of company restructuring: survival and success. While reorganization can boost productivity in some areas, it can also reduce it in others. When a company downsizes during a restructuring, the loss of talented employees may result in a loss of production. Delegating these workers' responsibilities to surviving employees frequently necessitates additional training costs. Employees who remain following a reduction may feel uncomfortable about their positions, leading to low employee morale and terrible customer service. When a corporation undergoes a restructuring that includes the latest tech or changes in employee responsibilities, production may suffer while people adjust to their new positions. Small firms undergoing reorganization can prepare to spend time and money retraining their personnel on the latest tech and procedures. Restructuring is a procedure that should be done with caution, considering both the benefits and drawbacks. People are likely to face the following challenges as a corporate director, investor, or other stakeholder. To sustain stakeholder support, a plan must be developed and implemented. To key decisions, early plan openness and more dependable knowledge are required. In the budgeting, forecasting, turnaround plan process, there is a lack of difficulty or sturdiness. Forecasting facilities or loan covenant violation. Change management and control are essential in business. Lack of information, challenge or tenacity on change efforts and the economic advantages they will bring. Inadequate managerial ability to drive, overseas and execute change while also operating the day-to-day operations. Urgently need visibility and control over cash. There is no accurate and reliable picture of immediate and middle cash requirements. Poor planning and insight to determine future financial needs, debt refinance status, and solvency program outcomes. Inadequate cash management, with disorganized payments all across the firm and too many employees capable of committing the company to prospective expense. Current operations must generate cash for the company. Long payback period with large money locked up in cash flow suppliers and customers placing further pressure on the profitability. Businesses must quickly discover and elongated shape profit enhancements. Profitability decline, that profitability did not predict, or unsustainable operating costs. Businesses are attempting to reduce costs as soon as possible. Expense knowledge and transparency are lacking. There is a need for skilled staff that can manage stakeholders and drive change. External, sometimes economic, parties are becoming more involved, changing demands for data on reform plans. Some crisis that necessitates management and stabilization. In a stressful circumstance, reorganization will necessitate talents that are not easily accessible in most firms. Businesses confront numerous challenges associated with the constant changes in today's market, and business reorganization can be both a short-term and long-term solution to relieve supplies viability. Whether the goal of corporate reorganization is to rescue the firm or strategically reposition this for the future, the financial specialists at Links Finance can assist business owners in dealing with these difficult situations. If you like the video, give us a like to make more videos like this one, and tell us in the comment section below what type of videos you want. Lastly, don't forget to subscribe to the channel for more weekly videos.